This is how I've made 10% ROI in just 30 days using one simple options strategy. Hi, I'm Noah Davidson, and in this video, we're going to go over one of my favorite options trading strategies for consistency, the highly touted, ever popular credit spread. It's a strategy that when used correctly, when you know what you're doing, has an 80% win rate or better. But that's the thing. You need to know what you're doing before you start opening up credit spread positions. If you don't know how to manage them, they could get you into trouble. It's an incredibly powerful strategy that I think you will find incredibly intriguing. So let's dive in. So what is a credit spread? A credit spread is an option trading strategy that can be done in a bullish manner, a bearish manner, or even in a neutral manner where we do both sides. And it's a very popular strategy because it's a passive income strategy where the risk capital we put up is sitting in our trading account and the profits come from the option we sell. We're going to sell an option and get paid. And in this example, we're going to do a bull put credit spread. Bull because we have a slightly bullish bias. Put because we're going to use put options. And it's a credit spread because we're going to sell an option for a credit and then turn around and buy a cheaper option to cover our asset, to cover our backside. And that's going to leave us with a net credit and a fixed or defined risk profile with an incredibly high probability of winning. So I have a really fun example for you here on a stock that we used in another example on how to do a debit spread. The stock is Nucor. It's a fun stock. Let's go ahead and dive in and take a look at it. So as I mentioned, the credit spread is a passive income strategy. And what we're not going to do is we're not going to try to predict which way this stock price goes. It is currently trading out here at about $150 per share. It's trading at $148 as of today's close. And I do think the stock price is going to rise. I do think it's going to rise with the general AI infrastructure build. I see the demand for steel increasing and Nucor's profitability going up. But I don't care if the stock price rises with this strategy. In fact, I don't care if the stock price stays the same and goes sideways. And in fact, I don't even care if the stock price goes down a bit, as long as it doesn't go down too much. Because what we're going to do is we are going to sell an option contract, and that's going to get us paid. And we're going to make a promise to buy this stock. Now, I wouldn't mind owning this stock anyway. They're a great company. They pay a tidy little dividend. It's got a good option trading personality, good stock personality, and they're fundamentally sound. I do think that they have a bright future with the AI infrastructure build. Now, that being said, I think you should only do credit spreads on stocks you actually do want to own, because there is a possibility that you could end up owning them if the option was assigned, and I'll walk you through it. So what we are going to do here is we are going to make a promise to buy the stock down here at a nice low price at $130 per share. And we are going to write a contract. And that contract, when we write it, it's a contract that is a promise for us to buy the stock. We are going to make a promise to buy it. And again, it's a contract, so a picture of a contract where you sign on the dotted line. And this will be a promise to buy this stock, to buy Nucor, at the $130 strike price anytime between now and the expiration date. And I'm going to put that expiration date just a little bit more than 30 days out here in December. We have that promise to buy anytime between now and the third Friday in December. So that's the terms and conditions of the contract. And right now, they are paying for that contract $1.40 per share. Now, each contract is worth 100 shares. So that means you get paid $140 for simply promising to buy the stock at $130. That's a good deal. I don't mind owning the stock anyway. Might as well get paid to make that promise. And then we're going to take that money that we received and turn around and buy a contract at a lower strike price, reserving the right to sell it. Because if we are making a promise to buy this stock at 130, that means we're promising to buy 100 shares for one contract, we would need to have $13,000 in an IRA account or retirement account to purchase that stock. If we used a margin account, they might hold less money there for us, but that's a different topic for a different day. So we would need to have $13,000, and technically the risk would be all $13,000 if the company went bankrupt and the stock price went to zero. Not likely, but it's possible. So we're going to turn around and take the $140 they gave us, and we are going to buy a contract giving us the right to sell the stock at 125. And we're going to purchase that contract. And that's an similar contract. Again, when we buy the contract, it's like signing the dotted line that gives us the right, but not the obligation, to sell that stock at 125 anytime between now and the expiration date and that third Friday in December. And that contract is going to cost us a whopping 90 cents per share, or a $90 per contract cost. And so we bring in $140, so we get plus $140, which is awesome. And then we spend the $90, so we spend the $90, and the leftover credit that we receive in this case is $50 or 50 cents per contract. And this is scalable, by the way. You can increase the number of contracts as you know what you're doing. And again, depending on how big your trading account is, would really dictate the appropriate position size. But that's the gist of it. We're going to make a promise to buy the stock. Just like selling insurance, we're promising to buy this stock if it were to get into an accident, if the stock price were to go down. And we chose the 130 strike price because it's a really high probability that the stock price doesn't go down there. My system rules dictate that I'm looking for an 80% probability or better. And this particular stock has better than an 80% probability of the stock price not going down below 130 between now and December. Now it could, of course it could. There's nothing to say it can't. But the statistical probability is actually closer to about 83%, somewhere in that ballpark, maybe 84%, that it doesn't go below 130 or expire below 130. Now, the problem is that, well, that means that there's about a 17% chance that it does. And that's always a possibility, and we simply have to respect that. But what we've done here is really, really clever. We no longer need $13,000 to cover the asset purchase, to cover that position. That would be called a cash secured put. Because we turned around and purchased the right to sell it at 125, we have limited our risk to the 5 points between those two strike prices, between 130 and 125. And for a single contract, that means that the risk is no greater than $500, or 5 points times 100 shares. So $500 risk. And you don't have to be a math genius to figure out that you can make the $50 and the risk is $500. Well, you're getting a 10% return on risk capital. So 10% ROI on your risk capital. And that risk capital, again, is $500. So we have $500 risk, and we wind up with a nice little reward of $50. Okay? And 80% probability that we win. So that's awesome. 80% probability, 10% return. But the problem is $500 risk. Why would we risk $500 to make $50? The answer is probabilities. The stock price here is really kind of cool if you look at it. We've got a support zone right here near 140. Last time it dipped to 140, people bought. We have another support zone down here near 135. Last time it dipped down to 135, people bought. And if the stock price were to go down to those price levels again, there's a probability that people would step up and buy. And then there's this big fat 200 period moving average, simple moving average that acts as a catalyst where if the stock price dips to the 200 period moving average, quite often the buyers step up and buy the stock because it's trading at its 200 period moving average and it's on sale. It's a good deal. So people would want to buy the stock because it's on sale. And the math models that the options use are highly sophisticated calculus models that can help us anticipate those probabilities and determine before we ever sell the contract what the probabilities are that the option would be exercised and we would be assigned the stock, meaning we have to buy it. And that, in a nutshell, is the credit spread. We sell a contract to get paid to buy the asset. We turn around and purchase a contract reserving our right to sell the asset. We have limited risk and, again, a high probability of reward. Now, I'm going to show you what that looks like on a risk graph. I'm going to show you what that looks like on a risk graph. So this is a blank risk graph, and I have the trade all queued up to show you. Risk graphs are pretty easy to understand, especially when you have a great teacher. And a risk graph starts out here at $0 risk, $0 reward. And if we see the graph plot above 0, that's the reward side. That makes us happy. And below that 0 line, that is where we experience loss or expenses. That's the risk. And that can be a bummer. We don't like that. And that stock price that we are used to seeing over here on the right-hand side of the chart is been turned over on its side, and the stock price is down here on the bottom of the chart. We said it was trading near 150. Well, this little hash mark indicates the stock price, and if you look down, that's about 148. That's where the stock price was closing as of today's market close. And we are making a promise to buy this stock down here at 130. So we're going to make a promise to buy the stock at 130 by selling a December, we're going to sell December, 19th of December, $130 strike price, and the premium that they are paying is $1.40 per share, or $140. And if I check that little box, the calculator will factor in the risk and the reward, and the most we make is that $140. You put that little cursor up here, the blue line, it says 140 down here in the left quarter. If you read that, it says 140. So we make $140. So we get paid that $140. And that, again, was a promise to buy the stock at 130. And you'll see here that they would require us to have the $13,000 because this is an IRA account, a retirement account. We have to have the cash to cover the option promise that we're making. Now, because we are taking our $140 of premium and turning around and purchasing that 125 put, you can see that down here. We have the +1, we're going to buy it. New core December 19 of 2025 put option. It's the 125 strike, and it's going to cost us 90 cents. And so I factor that in, and boom, just like that, you'll notice that our BP effect, the account requirement, the capital requirement for this trade goes all the way down to $500. And our profit zone goes down to 50 because we spent 90 cents. So again, the 140, we get to keep the 140. But we turned around and we spent 90 cents or $90. And so we are left over with a net credit of $50. Now, you'll see some numbers up here in the top of this graph. You'll see here where it says 84.92%. Let me get this dialed in just right. If it's right at 130, it was just a little bit off. Right there it says 85.01% probability that the stock price is above 130 at expiration. Now over here on the left, you'll notice that there it says is about 14.99% probability that the stock price is down below that 130 number. And that leaves us with $450 of maximum risk because, again, we promised to buy 100 shares at 130, have the right to sell the same 100 shares at 125. The most we could lose is 500, but we get to keep the $50 no matter what. So, therefore, the risk is $450. And that is money that is in our account, just earmarked. It's being held in order to cover those positions. We have that money held, but in the meantime, we make $50. Now, this is scalable. And what that means is, well, what if I sold 2 contracts and bought 2 contracts? Well, now my maximum reward's $100 and my risk is $900. Well, what if I did 5 contracts? Let's do 10 contracts. What if I did 10 contracts and I purchased 10 contracts to cover it? Well, that means we'd make $500 and we would need to have $4,500 in our account. It is scalable, and how big of a position size you take really is determined by your account size and your risk tolerance, and those two numbers need to be aligned. And the important thing about credit spreads is that you have a system and you have rules. My system and rules are dictated as such. I always look to sell options with better than an 80% probability that they expire worthless, out of the money, and I get to keep the premium. I am looking for a minimum of 5 to 10% is my target. That's what I really am looking for. ROI on capital used. It's easy to find 5%. Finding a candidate that'll pay you 10% is ideal. We like the 10% more than 5% just because it's 5 more percent. And I typically will sell those options contracts anywhere between 30 to up to 60 days. I'll go as far out as 60 days, but really what happens is the option time decay starts to increase really rapidly under 30 days, and out past 60 days, the time decay is not as effective, but 60 days or less is a pretty good range for writing credit spreads. I tend to, again, err towards 30. In this exact example, it's actually 37 days. Or take that back, it's 36 days. 36 days until expiration and the 10% ROI. So 10% over 36 days. Now, I'd be curious to know what your rules are for credit spreads if you're trading them, and what you've discovered about trading credit spreads. It's an awesome strategy. Again, an incredibly powerful strategy. The high percent yield in the very short period of time, even though it only sounds like small numbers, and we're talking about $50, but 10% over 30 some odd days is such a high percent yield that if you understand compounding, you understand the power of compounding, that means you could be doubling that money every year once you account for a drawdown or two and any risk management involved. The problem with this strategy, if you haven't noticed, is the risk. The risk is high compared to the reward. What makes it acceptable? The probabilities. That's the easiest way to think about it. We have a statistical edge. And the key to success is learning proper trade management, and that's what we excel in. That's our expertise over at the Cash Flow Academies. Not only do we teach you how to build, identify, and build great credit spreads, we teach you how to manage them when they go good, when they go bad, and when they go ugly. And if we can control and mitigate the downside risk, then that means we can reap the benefits of learning to write credit spreads the right way. So that, ladies and gentlemen, in a nutshell, is a credit spread, a bull put credit spread, an incredibly powerful and popular strategy. And by now, you're probably starting to see that opportunity that options trading presents and how it can help you grow your portfolio. It's a big deal. That's a really high rate of return and an incredibly valuable skill to learn. But there's a cost of entry, definitely a cost of entry. You need to have some money set aside to learn how to do this. How much money does it take to start trading options exactly? Well, I'll answer that question for you in this video right here, and I will see you in the next video.